Good morning, everybody, and welcome to our accounting standards update, getting ready for 31 December 2019. Today, I'm presenting this webinar all on my own because my fellow partner, Kevin Frobis, is unwell and has actually lost his voice. So you stuck with me today. Now, in our November accounting update, we will have 5 sections. First of all, we'll focus on for-profit entities, and we'll look at the standards and interpretations that are effective for the first time for 31 December 2019 year ends. In the second section, we'll have a bit of a spotlight on not-for-profit entities and look at the standards and interpretations effective for the first time for 31 December 2019 year ends. In the third section, we look at standards and interpretations issued but not yet effective, a very high-level view. In the fourth section, we look at Australian-specific developments. And in the fifth section, we look at the ASIC regulatory activities. So that's just an outline of our sessions. So if we start with our very first section, looking at for-profit entities, if we have a bit of an overview first of all, the new standard for 31 December is my beloved IFRS 16 leases. For sure, these days, my favorite standard. Spend most time with the standard. And then amendments to standards. We've got 4 standards where we've got amendments. An amendment to IFRS 9, an amendment to IAS 28, amendment to IAS 19, as well as the annual improvement cycle 2015 to 2017. And then a new interpretation, IFRIC 23, uncertainty over income tax treatments. Now this IFRIC 23, I think, is a little bit of a interpretation that's been overshadowed by all the new accounting standards that became effective recently, as well as IFRS 16 effective for 31 December 2019. So we'll look at IFRIC 23, highlight some of the issues in IFRIC 23, but I would like to say up front that please don't overlook IFRIC 23. Please consider whether it's applicable to your organization or if you're an auditor to your clients. Make a risk assessment and make sure you've got all the documentation in place early on. And remember, you might need some input, or I would suggest you need input from tax professionals, transfer pricing, corporate tax, R&D tax as well. So that's just an overview for for-profit entities, what's in the pipeline or what's effective, for 31 December. Now, first of all, IFRS 16 leases. The standard that at this stage I like the most, because I do most work in this area, advising a lot of clients with the implementation of IFRS 16. And then obviously at BDO, we have a technology solution, BDO Lead, which is software as a service, cloud-based, but you can also outsize your lease accounting to us, where we do BDO lease management services. So our IFRS advisory team, very familiar with IFRS 16, lots of clients in that space. If we look at IFRS 16, a bit of a recap on the financial statement impact. I think in our experience, most of our clients or entities we speak to, auditors, very familiar, high level, what will happen with the adoption implementation of IFRS 16. When we look at earnings, there will be higher EBITDA. There will be lower profit in the earlier years because there's a front-end loading of the interest expense, and then potential increased profits towards the end of a lease. But I think the key thing when you look at profit is the fact that it's profit volatility. It's not an even impact on profit anymore. If you look at your statement of financial performance, we have higher assets, and our right of use assets, the right to use a building, a property, equipment, is now on the balance sheet, similar to assets that we own. Then we also have an increase in our debt and our lease liabilities. and therefore no longer are lease commitments hidden away in a note, but it's actually front and center on the statement of financial position, and it's split between current and non-current, and that's important to remember because the right of use assets are non-current assets. However, the lease liabilities are split between current and non-current liabilities. It worsens your current asset position, therefore, because there's no more or no new current assets, but we have often significantly new current liabilities. When we look at the cash flow statement, we've got higher operating cash flows. However, we now have cash outflows that are linked to financing, repayment of the loan, as well as potentially interest expense, depending on your accounting policy. Some other things, more business related, could be a potential problem for our bank covenants. It could have an impact on our bonus arrangements. The selection of appropriate transitional method could have an impact on the declaration of dividends. And then often entities realize that they need system changes. Now, a lot of entities with their hundreds or thousands of leases are looking for a technology solution, a cloud-based solution, where they can themselves manage their leases and their lease financial reporting obligations. However, others with, let's say, up to around 100, 120, 150 leases are just looking to outsource it to BDO or other organizations to take the hassle away, and we do all the calculations using BDO Lead. When we look at IFRS 16, one of the big issues is actually lease identification. Previously, there was an interpretation for IFRIC 4 looking at lease identification. One would say it was an interpretation that was sitting fairly separate to the standard IAS 17 or AASB 117, and in my experience, that interpretation was often overlooked. Now, with the new AASB 16, lease identification is embedded in the leasing standard AASB 16 or IFRS 16. And it's got some subtle changes to lease identification and the definition of a lease. And in practice, we've seen that there could be some changes to the identification of leases. Now, this decision we've previously discussed in a webinar, but I thought it's important to highlight it again because we've seen it to be problematic at so many clients. The first one is in order to determine whether we've got a lease or not, and therefore whether we're subject to AASB 16 or not. The first step is to consider, is there an identified asset? So an identified asset would be if we lease a particular vehicle, lease a particular property, and if we think at a property, it is a particular space at that property that we're leasing. So if you have an arrangement where you go in and you can use a desk in a big area, it's not a specific desk, a specific office, similar to the WeWork arrangements we see, and that's an scenario, the shared space scenario. Possibly you don't have an identified asset because every day when you arrive, they could give you a different desk and a different space to use, similar to pop-up stores that could move around in a shopping center. So the first thing, do we have an identified asset? The second aspect is, does the customer have the right to obtain substantially all of the economic benefits from the use of the asset throughout the period of use? And you can see this assessment is therefore based on, do we get all the benefits throughout the period of use and not throughout the useful life of the asset? So if I lease an asset, a building for 3 years, and I get substantially all the benefits for the 3 years, I would tick this box. So we're not saying I'm leasing an asset for 3 years. The asset has a useful life of 15 years, and therefore I'm not getting substantially all of the benefits. So that was an old assessment we made under finance versus operating leases as a lessee, where with the new identification of a lease, we only look at the asset that we get substantially all of the benefits from the use of the asset throughout the period of use, not useful life. And then the third aspect and the final hurdle really is, does the customer, the supplier, or neither party have the right to direct how and for what purpose the asset is used, again, throughout the period of use? Now, if it is the customer, the potential lessee, directing the use of the asset throughout the period of use, we've got a lease. If it's the supplier that directs the use of the asset, we don't have a lease. And then if it's neither, we go into different criteria that we have to consider. So does the customer have the right to operate the asset throughout the period of use without the supplier having the right to change those operating instructions? If we say yes, again, then we've got a lease. So again, the control is in the hands of the customer and the supplier can't interfere. So it's been predetermined. If we say no, we would say, did the customer design the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use? So you can see in these last two questions, it is all around establishing whether the customer controls the use of the asset. It could have been predetermined, or it could be ongoing that the customer has the control. But ultimately, if the customer has control over how the asset is used throughout the period of use, then we've got a lease. If the supplier has that control, then we don't have a lease. So lease identification, really important. An example that maybe makes it a bit more realistic, we have a number of clients or local council clients where they have service agreements in place, and those service agreements are for companies to come and do the rubbish removal for that council area. And there's a schedule on when you have to put your bins out. We put it out on a Thursday, and the council or the service providers of the council come past and they remove the rubbish, recycling, etc. In that scenario, although it's a service agreement and the council has service providers who come in to do the rubbish removal, what you'll see is on the side of those trucks, it would say the name of your council, and it would look as if it's trucks that would belong and owned by that council. So there's a service agreement in place, but embedded in that service agreement is a right by the council to use those delivery trucks or to use those rubbish removal trucks, because they can only be used in that particular council due to the branding. The council would direct where they used, where they pick up rubbish, etc., what route they drive, absolutely under the control of the council. So that's in my scenario. So potentially in that service agreement, we have an embedded lease. Another one that is interesting would be around if you have a service agreement around data centers, and would that service agreement potentially include an embedded lease for the data racks where your servers are placed and kept at the right temperature and the right flow of electricity, etc. So lease identification, a few additional considerations, I would say practical considerations. We would ask entities, do you have an up-to-date lease register covering your properties, vehicle, equipment, and other assets that are likely to be on a leased basis? As Dean recently said to a number of our clients, when you walk around your premises, if you look at your assets, do you know which of these assets are actually owned and are in a fixed asset register, and which of them are leased And if they're on your property on a permanent basis, are they in that lease register as a right of use asset? So it's a bit of a sense check whether your lease register is complete or your fixed asset register or fixed asset register is complete. Also, and maybe a different way to think about it, are there any service agreements whereby the services that's been provided to your entity rely on the use of assets that are controlled by the entity? Another example that I can think of there, if you're a sporting organization and you've got a service agreement with an organization to do the maintenance and cleaning of your grounds. Now, I'm a bit of a cricket tragic, and therefore, with the cricket, if you do the cricket pitches, you need a roller and a bit of equipment that stays at that cricket oval. So that service agreement to do maintenance, if the roller and other equipment permanently stay there to look after the pitch, in that service agreement we have an embedded lease of that equipment. And then also another thing to think about, are there arrangements that provide the entity with the right to use assets together with other services? So service agreements definitely the area to think carefully whether embedded in those service agreements we also have us as an entity have the right to use an asset. When we look at leases, it's important when we consider the initial application of AASB 16 to think about the different transitional methods that's available. A lot of people make the mistake when they think there's only two methods available, full retrospective method and modified retrospective method. Modified retrospective method actually branch off in two different methods. We've at BDO called the one method modified retrospective method 1, which is where your right of use asset equates to the lease liability, which you determine first, plus or minus the accrual or prepayment under the old AASB 117. So that's the simplest, quick and dirty calc. And then the other modified retrospective method, which is completely underestimated by clients, is modified retrospective method number 2. Where the right of use asset is calculated on a retrospective basis. However, you can use a lot of practical expedients to make that calculation easier. And you also use the incremental borrowing rate at the date of initial application. You don't have to go back to determine the incremental borrowing rate at the start of all the various leases. However, your lease liability is still forward-looking. The reason I'm saying that this modified retrospective method number 2 is underestimated is there are a number of really good benefits if you use this method. And I would like to flag that up front. So I'll come back to that benefit, but let's start by looking at the other two methods. If you look at full retrospective method, clients don't like that method because you need near perfect historical information. If you've done business combinations over the last number of years, or you've got very long-term leases, really difficult to do all the calculations, very time consuming, and really it's a big exercise, complex. Of all our clients that have implemented, that we as an advisory team have assisted with the implementation of IFRS 16, only 2 of them have done full retrospective method. They could because they had a big team that could work on it. They had near perfect information, and then also they could use our technology solution to help. Full retrospective have the benefit that you've got comparable information, but the key benefit actually is that on the date of transitioning to IFRS 16, you have your lease liability, you have your right of use asset, and you have an adjustment to your retained earnings opening balance. Therefore, the impact on your profit and loss on an ongoing basis is less because you actually take the hit to retained earnings opening balance on the date of implementation of AASB 16. If you contrast that to the other extreme, modified retrospective method number 1, where you work out your lease liability forward-looking based on your incremental borrowing rate at the date of initial application, and then you say, okay, if this is my lease liability, let's just equate that to the right of use asset on date of initial application. It's quick, it's dirty, it's simple. However, big downside is it pushes a lot of depreciation expense into the future, and it therefore quite negatively impacts profit and loss on an ongoing basis. So, you know, a lot of clients are saying, listen, full retrospective, I don't have the time, the data to do it. However, I hate the fact that modified retrospective number one is creating some future issues with profit and loss. And then I would always say, but remember modified retrospective number 2, which is a little bit of gold there, which is a little bit of a halfway house between full retrospective and modified retrospective. And the big benefit is that it also has a debit to retained earnings opening balance on the date of initial application, and therefore minimizes the impact on future P&L, because depreciation on the right of use asset, historical depreciation on the right of use asset, is actually booked to retained earnings opening balance. So modified retrospective method 1, if you're concerned about the ongoing impact on your P&L, definitely a method worth looking at. If we look at the practical expedience, the standard setters would like to encourage organizations to implement AASB 16, and therefore they've made available a number of practical expedients. This particular practical expedient, where you grandfather your previous assessment of whether you have a lease or not under IAS 17 and IFRS 4, is available to full retrospective and both modified retrospective methods. This is actually the only practical expedient available for full retrospective method. The one thing that I would say is, please be careful that you cannot grandfather an incorrect previous assessment, or you cannot grandfather if you never made an assessment according to these standards and IFRS 4. So please be careful with that. If you look at the other practical expedients, there's another 5 practical expedients, and they all relate to the 2 modified retrospective methods. And that is saying, you know, for example, we can apply a single discount rate to a portfolio of leases with similar characteristics. There's some practical expedients around onerous leases. There's a practical expedient around initial direct cost. Number 5 is a practical expedient around leases which on the date of initial application have less than 12 months left. And then in practical expedient number 6, to use hindsight, such as determining lease term, when you do implementation on date of initial application. So these practical expedients, when we look at the modified retrospective method, make the calculations much more doable. You don't need perfect information. It's definitely faster than full retrospective. This is a diagram illustrating the different practical expedients that would be applicable to the different transitional methods. So just to give you a bit of an overview. However, I would say it's really important to carefully consider the impact on the transitional methods, not just on the date of initial application, but also to do a forecast on the impact over the next 5 to 10 years before you make a decision. It's important that finance teams don't take the easy way out, but actually consider a modeling of the different alternatives and put it to the Audit and Risk Committee to make that decision. If we look at IFRS 16, a little bit of maybe a few questions to ask, just to get you thinking along the right way. Lease identification. Have you identified all your leases? We've discussed that earlier. Lease definition. Are there any non-lease components that should be separated from lease contracts? So, for example, if you're leasing a building, you have your lease payments, but you also have to pay for water, electricity, security, maintenance of common areas, etc. The standard says you should separate the two. As a practical expedient, you could keep it together, but then you should treat it as a lease. So make a decision on that. Also consider the scope exemptions. For example, you can exclude short-term leases. You can exclude low-value leases if you want to. Do you want to do that or not? The fourth one is around lease term. Have you considered all your extension options, purchase options, termination options? Have you documented and considered whether you're likely to exercise those or not? How does it interact with your lease term? Variable lease payments, for example, CPI payments. So when we do lease calculations, we only include fixed payments and in substance fixed payments. We do not include variable payments, therefore we don't include future market reviews, future CPI increases, but also do you know how to deal with them on an ongoing basis? And then discount rate, do you know the rate implicit in the lease? If not, do you know your incremental borrowing rate? Have you gone through a process to determine that? It's not necessarily one incremental borrowing rate for all leases. Usually there's a difference between short-term and long-term leases. The term has an impact on the incremental borrowing rate. What are your current liability? What's the current interest rate you're paying on liabilities as a starting point? And we know especially for our not-for-profit clients, this is a difficult thing to determine incremental borrowing rate because often they don't have any debt. And same with public sector, difficult to come up with that rate. So a transition plan, consider all your leases, determine the impact of these leases on your financial statements, your ratios, your KPIs. Consider the impact on covenants, remuneration arrangements, tax, dividends. Educate your staff. How are you going to deal with do you need to change your systems and processes? And then a big one, the second last one, which is often overlooked, is how are you going to deal with changes or modifications, reassessments to lease contracts? And how do we communicate all of this with our shareholders or to our shareholders in a timely fashion? The second last point on that slide, I thought I'll go on and share this diagram with you. Now, this diagram we've developed as we've been implementing AASB 16, and in particular, as we've been providing BDO lease management services to a lot of our clients. Because once we've done a selection of an appropriate transitional method, once we have implemented AASB 16, a lot of people think, okay, it's done, it's a set and forget. And then we realize on an ongoing basis, every month, we go to the clients and we ask them, are there any changes to your lease portfolio? And they say, what do you mean changes? And I say, okay, it could be, if we work on the yellow level from the left, there could be a change in your original assessment of whether you'll exercise a purchase option, termination option, lease extension period. So you could change that. There could be a change in estimate of residual values, so maybe a change in an estimate of a balloon payment on a vehicle. There could be a change in an index or a rate. For example, CPI changes that come through regularly, market reviews that happen. if you go on just that yellow line, there could be that we increase the scope of a lease, we could decrease the scope of a lease. Initially we're just leasing level 18 and now we also lease level 19, or initially we leased levels 18, 19, 20. But there's been a change in the economy and we only need a one level. So all of those are changes to your lease portfolio. Another change, which is not on this diagram because it is not captured within these requirements, is you could enter into new leases on an ongoing basis. Some clients every month they say, oh, we've got 2 more vehicle leases, we've got 1 more property lease, and all of that constantly then have to be incorporated in your right of use asset and or your lease liability. Now, why make such a fuss about the things on this slide? You'll see in the top block I've said these are all changes that can happen to your leases. And it's important that you, in the first instance, categorize them as being reassessments or modifications. A modification is if there's an actual modification to the legal agreement. Reassessments are basically when you reassess, rethink your previous assessments, judgments around lease terms or residual values, or if your CPI adjustments or market reviews become available, or in the information from those reviews. The two big parts in this diagram lead to very different outcomes. Reassessments on the left-hand side, very different outcomes to modifications. And actually, if you look at reassessments, there are 3 different types of reassessments, each with a slightly different accounting outcome. So if you look at the far left, the new discount, the change in the lease term, if that happens, you have to update the discount rate that you've used at the date that you change your view on the lease term. If there's a change in the residual value, you can still use your original discount rate, and the same with the CPI or market review. However, for all of these reassessments, there will be an impact on your right of use asset and your lease liability at the date of this reassessment. And that's an ongoing thing. If you look at modifications, more complex, you have a legal modification to an agreement, and now it comes down to, is there an increase in the scope or decrease in the scope? And if there's an increase in the scope, are we paying market-related amounts, yes or no? And if there's a decrease, we have to use, or actually a change in scope, we have to use a new discount rate. And if there's a decrease in scope, there could be a potential P&L impact because you're de-recognizing part of the right of use asset, you de-recognize part of the lease liability. And the difference between the two, because they're hardly ever the same, the difference between the two will lead to a P&L implication. So the ongoing managers of leases and the ongoing management of the lease portfolio is definitely problematic. And a lot of clients who initially thought they'll manage their leases themselves in Excel end up turning to us and saying, can you please use BDO Lead and manage this for us? It's a nightmare. The other items that we know we've got changes to standards are amendments to IFRS 9 around prepayment features with negative compensation. So this we've discussed at an earlier webinar. I didn't want to delete the slides. I thought I'll put it back in for those of you who are dealing with this particular issue. You can have a look at that. I've also kept in the slides on the amendments to IAS 28. Long-term interest in associates and joint ventures. Again, we've discussed it previously. It's a fairly narrow scope amendment. Again, if that's of interest to you, you can have a look at that. The annual improvements cycle 2015 to 2017, which is now effective, has a number of amendments around amendment to IFRS 3 business combinations. We also have an amendment to IFRS 11 joint arrangements. We've got an amendment to IAS 12 income taxes, and also an amendment to IAS 23 borrowing costs. Again, all of these we've previously discussed in a webinar, so I thought I'll just flag it as a reminder. The other big thing that I want to talk about for for-profit entities, however, is AASB Interpretation 23, uncertainty over income tax treatments. This poor interpretation has the same effective date as IFRS 16. However, it's been largely overlooked because everybody's been so busy with IFRS 9 and 15 and now IFRS 16. But please consider this carefully and make sure that you're ready for this interpretation. So IFRIC 23 clarifies when and how to apply the recognition and measurement requirements of IAS 12 income taxes when there's uncertainty over income tax treatment. So when would we have uncertainty over income tax treatments? Where the tax law may not be clear, and the application date is for periods beginning on or after 1 January 2019. Early application permitted, I haven't seen that, and therefore 31 December 2019 year ends, the first year ends impacted by this. I know at BDO, we've had, our transfer pricing partners, our corporate tax partners, our R&D partners have been very busy working with clients to get ready for IFRIC 23 and also working with audit clients around IFRIC 23. So the issues addressed by IFRIC 23, first of all, whether an entity considers uncertain tax treatment separately or together. The assumptions an entity makes about the examination of tax treatments, and I don't know why this is rolling too fast. Also, how an entity determines taxable profit, tax bases, unused tax losses, unused tax credits and tax rates, and also how an entity considers changes in facts and circumstances, whether it's a change in estimate, is it an error, what's going on. So when to apply IFRIC 23 is always the first question. And I like this diagram that's been developed by somebody in our BDO Global IFRS team. And first of all, it said, listen, if IFRIC 23 does not apply when it is probable that a tax position will be accepted. So more than 50%. So between 51 and 100%, if we think it's probable that the tax position that an entity has taken will be accepted, no worries, IFRIC 23 would not apply. However, IFRIC 23 applies when the probability that a tax position will be accepted is less than 50%. So IFRIC 23, only the less than 50%. When IFRIC 23 does not apply, the blue part, if it's probable that we'll accept a tax position, all those assumptions will be used in calculating current and deferred tax. So it's factored into current and deferred tax. However, for the part where the tax position is not probable to be accepted, when we apply IFRIC 23, then this uncertainty around the tax position will form a component of measurement, and I think that's really important. There's also additional disclosure requirements that have to be adhered to. So the question, are uncertain tax treatments considered separately? It's a principle-based answer in that you use the approach that best predicts the resolution of that tax uncertainty. So you'll consider how an entity prepares its income tax returns and supports income tax treatments. Do they look at these things together or separately? And also, you'll consider how the entity expects the tax authority to examine and resolve issues relating to the uncertain tax treatment. Very important, and I think this is maybe the biggest change, is that you will assume that a tax audit will be conducted. So we will say how to determine the impact of uncertain tax treatments. You ignore the probability of having tax audit when calculate the amount of tax owing. So previously, in a number of jurisdictions, entities would say, listen, we don't think this tax outcome maybe is probable. However, knowing that it's unlikely to have a tax audit, we push ahead with that treatment. That could have happened in certain situations. And IFRS 23 says, no, you come up with an appropriate treatment and you ignore the probability that whether there'll be a tax audit or not. You actually assume that the tax authority has full knowledge of all the facts and circumstances, and you assume that the tax authority will perform a tax audit, and then you do the accounting under IFRS 23. So when would we reflect the effect of uncertain tax positions in tax calculations? We'll reflect that uncertain tax position if it's not probable that that tax authority will accept the uncertain tax position, and also ignoring whether they'll actually do the tax audit or not. This is just the same diagram again. I must love this diagram because I've included the slide twice. So what if facts and circumstances change? If facts and circumstances change, you reassess your judgments to consider the impact of these new facts and circumstances. When would this happen? The tax authority has taken a particular course of action, so they've agreed or disagreed with an uncertain tax treatment, or information becomes available about the amount received or paid to settle a similar tax treatment, and therefore you know that you know what the outcome is going to be. There have been changes in rules established by the tax authority, so previously unclear, now we know. And the tax authority's right to examine or re-examine a tax treatment has expired. If you look at disclosure, actually, when you look at the disclosure requirements in IFRS 23, nothing's new. It is just pointing us and emphasizing that you have to apply the disclosures in IAS 1 and IAS 12. But it's a new emphasis on those disclosures. So IFRS 23 absolutely overshadowed by IFRS 9, 15, and 16. Some practical suggestions, and these are practical suggestions that I actually received from our tax partners, where they said clients should develop a register of uncertain tax positions, evaluate the technical merits of each position, identify, document whether the outcome is probable or not probable, and if it's not probable, calculate and book the most likely amount or expected value. Other issues is potentially the interaction with tax experts, transfer pricing, etc. A very big issue, especially for our audit friends, is the interaction between entities and audit teams, and entities making sure that they provide sufficient appropriate audit evidence to our auditors, and that they document their judgments, their thinking, and their processes. Very hard for auditors to have an assessment of what you've done around IFRS 23 if you don't have a clear process and a documentation of your judgments. And then also a last point is to consider independence implications. If you've got a significant piece of transfer pricing advice that you've received, to make sure that that is, if it's a significant piece of work potentially received and you're a listed entity, whether it is still appropriate to receive that from, the same audit firm. There's stricter rules for listed and public interest entities than there is for non-public interest entities, but I think it's definitely something to keep at the back of your mind, whether you're still happy with the independence rules and that you're adhering to those. If we move on to our not-for-profit entities, an overview, you can see there's a lot more happening for our not-for-profit entities. New standards, they've got AASB 15 and AASB 1058, as well as AASB 16. And then you would also know that the AASB has deferred the application of AASB 15 and AASB 1058 to research grants, only research grants of not-for-profit entities. Not-for-profit entities that have significant research grants have another 6 months to get ready for that, but they still have to apply AASB 15 and 1058 to all their other agreements. Also AASB 16, and then a number of amendments to standards. And there's been a bit of a delayed application for not-for-profit entities. Therefore, for for-profits, 31 December, there's 4, and for not-for-profits, there's 6. 2 of them is a bit of a delay. And then new interpretations, again, IFRS 22 is already applicable to for-profits, but 31 December, the first time that it's applicable to not-for-profit entities. If we start off by looking at AASB 1058 or AASB 15, definitely a complex process. I should start off by saying, bottom line is, if you're a not-for-profit entity, for any transaction, your starting point would be AASB 1058. AASB 1058 gives you directions on where to go. So in the grey part of this big decision tree, it says, if you've got a transaction, if it's a share-based transaction, apply AASB 2, and if it's a business combination, apply AASB 3, etc. And if it's none of those, stay here in 1058. If it's got to do with volunteer services, apply paragraphs 18 to 22. If it's not volunteer services, again, stay in AASB 1058, but let's see where we go next. And then on the left-hand side, this predominantly green diagram is looking at what is the debit entry. So if you've obtained this asset, is it an equipment, is it an intangible asset, is it a right of use asset, exactly what is it? And then the predominantly yellow diagram on the credit side, do we have a lease liability? Do we have a financial liability? Or is it income under AASB 15, or is it maybe income under AASB 1058? So this is a real big, super big picture view of how the application of 1058, AASB 1058, works to not-for-profit entities. If we break them down and look at them individually, the first part of that decision tree, the predominantly grey decision tree, is looking at the scope of AASB 1058. And basically, the first step is, if you've got a transaction where you acquire an asset and it's occurring in a not-for-profit entity, you apply AASB 1058, end of story. If that acquisition of an asset is somehow through a share-based payment, a business combination, an insurance contract, a license, income taxes, or a restructure, apply these standards. And if there's something left, you stay in the standard, you come back to the standard. So it's really a traffic light system. Does the transaction relate to the receipt of volunteer services? If you say yes, you stay in AASB 1058 and you apply paragraphs 18 to 22. If not, there's one decision tree looking at the debit side and another one looking at the credit side. If you look at the debit side decision tree, the first thing is, have you received this asset, in a transaction that is any part of this asset that you've received a financial asset, then you apply AASB 9, or if it's a property, plant and equipment, AASB 116. If it's through a lease, there's a right of use asset, AASB 16, etc. I think what's really important to note here is once you go to, for example, AASB 116 for property, plant and equipment, the standard then asks, have you received this property, plant and equipment at significantly below cost and to further your objectives? So there's two limbs there, because if you answer yes to both of those, you are actually required in terms of an OZ paragraph in AASB 116 to fair value that asset and not book it at cost. For-profit entities will book it at cost. Not-for-profits, if they meet those two limbs, they would meet it. They'll book it at fair value. If we look at those two limbs separately, the one is significantly below cost. We would say there's a lot of judgment to when is something significantly below cost. Is it 10%, 20%, 50%? What is significantly below cost? And the second limb, did you get it to further your objectives? What if you were just really good at negotiating a really good price? So if you paid a good price, significantly below cost, and it's because you've negotiated really well, arguably that OS paragraph wouldn't affect you and you would book the acquisition of that asset at cost. So it's important to consider the two limbs. And then if we look at the credit side, so the credit side of the entry, the first thing we'll ask is if we received the funds, were the funds received for the purpose of acquiring or constructing a non-financial asset? If that is the case, you apply paragraphs 15 to 17 of AASB 1058. If there's something left, you ask, is it as a result of a contribution from owners? Do we have a lease liability? Do we have a financial instrument? Do we have a provision? And you will look for all the, I would say, obvious things. And then at the bottom of this decision tree, it's where it becomes really critical to now consider whether AASB 15 or AASB 1058 is applicable to the remaining part. So in this decision tree, I've just broken that last bit down a bit and focusing on that decision, whether it's whether the credit side is AASB 15 or AASB 1058. First of all, you'll ask whether there's a contract with a customer, and there's guidance in these standards on when we have a contract with a customer in a not-for-profit world, and also whether that contract is enforceable. So if you're not spending the money on a certain purpose, do you have to repay it? As an easy example, it could also be significant penalties involved. If you say no, then you apply AASB 1058 paragraph 10. If you say yes, there's another hurdle to jump, and that is, does the contract contain sufficiently specific performance obligations? And now that's a really hard question and very judgmental. If you say no, again, you apply AASB 1058 paragraph 10. And if you say yes, you say, okay, now I can apply AASB 15. But please note, it doesn't automatically mean that you'll be able to recognize revenue over time. But once you're in AASB 15, you'll follow the rest of the steps 3 to 5 in AASB 15 and consider whether you would recognize revenue at a point in time or over time. It at least gives you a chance to recognize it over time, but it's not an automatic, if we can put it that way. I want to come back to that hurdle you had to jump to get to AASB 15, and that is, do we have sufficiently specific performance obligations? As we've been helping not-for-profit entities over the last 12 to 18 months to get ready for this new standard, it's dawned on us that it might be helpful to consider the differences between activities, and I would say internal activities, outputs, external outputs, and outcomes. And why would it be helpful to look at these three buckets? It's because internal activities definitely would not give us sufficiently specific performance obligations, because there's no transfer of goods or services to customers. It's all internal focused. Example would be if we get funding to employ an employee to work in our not-for-profit entity. Fantastic to get the funding, fantastic to be able to employ an employee, but it does not involve transfer of services or goods to a customer, or no specific requirement to transfer goods or services to a customer. So you have to be very careful. Is it an internal activity, or is it maybe an output? Now, an output is external. It involves the transfer of a service or the provision of a service or the transfer of a good to customers. So we talk about external outputs. And as soon as a funding agreement or a grant lists external outputs, then we can say very easily, now we can determine when we deliver those outputs, when we provide those services, we can measure progress, and now we could say that means we've got sufficiently specific performance obligations, and therefore we get to consider the application of AASB 15. The last one, which can often be problematic, would be outcomes. You receive funding to achieve certain outcomes or promote certain outcomes. Would those automatically be sufficiently specific performance obligations? Usually not. However, it's a gray area. Sometimes these outcomes or these visions or these goals imply required outputs, and you can measure progress of those outputs. As an example, if you receive funding to promote the number of female coaches or increase the number of female coaches in a certain sport for, let's say, by 10%, that's an outcome. However, it would imply certain outputs, so training courses, etc., and therefore it's linked to these outcomes. Maybe it could be sufficiently specific performance obligations as we reach that 10% increase in female coaches. We could say, all right, now we've achieved, now we can recognize our income. So that is a gray area. Outcomes becomes quite hard. I also want to flag with you that BDO has a number of free resources available for our not-for-profit entities. There's the interactive e-learning for AASB 15, 1058, AASB 16, similar to the for-profits, but there's also a custom-developed not-for-profit interactive learning module, and I've given you a screenshot from our website where you would be able to find that. If we then move on to section 3, to standards issued, not yet effective. An overview, there's a new standard IFRS 17 on insurance contracts. There are amendments to standards definition of a business and definition of material, and no new interpretations in the pipeline. So that's great news, a little bit of stability. Sorry, this previous slide was specifically looking at for-profits. If you look at not-for-profit entities, 2 new standards, so not just the insurance standard, but also AASB 1059 around service concession agreements, accounting treatment by grantors, and the same amendments to standards as for-profits, and also no interpretations. I would now like to move on to a very topical and I think relevant section, which is Australian-specific developments. I've recently provided a session just on the Australian-specific developments to a number of our business services and or private clients internally, because this has a big impact on organizations in Australia, a big impact on whether you need to lodge financials with ASIC or not, whether you need to lodge general purpose or special purpose financials. So I'd like to touch on this as well. A lot of changes, and I was trying to pull together all the relevant requirements into one section, and it's amazing how many moving bits there are at the moment. So if we start with the Treasury Amendments, we know that for years beginning on or after 1 July 2019, so that's basically for our 30 June 2020 financials, there's a doubling of the reporting thresholds for large private companies reporting to ASIC. So they are the current thresholds. If you're above those two of the three thresholds, you have to lodge your financial statements with ASIC. The new thresholds for large, so it's doubled. If you've got two, you meet two of the three, you have to continue to lodge your financials, audited financials with ASIC. I would like to say that please be very careful. If you are no longer large, and you're no longer required to lodge financials with ASIC, please be very careful before you decide to no longer have an audit. There's tremendous value in an audit. External party, independent party, looking at systems and processes. I think it's important for employees to know that there will be external auditors coming in and having a look at all these things, reporting independently to the board. So although you're no longer lodging with ASIC, I think very carefully around the audit aspect. And I think it's really important to keep up that audit, especially when you're currently within the rigor of an audit. So if you if with the impact of doubling of the reporting thresholds, you must still keep your financial records if you no longer have to lodge with ASIC. You still have to prepare or audit financial reports if you're directed by ASIC or shareholders with at least 5% of the votes. You no longer need to prepare financials, have an audit, lodge financials with ASICs within the 4 months. But as I've said earlier, please think very carefully about an audit, great value in an audit. Then if we look at what would the impact of the doubling of the thresholds have on our grandfathered large proprietary companies, so no changes have been made to the requirements for grandfathered large proprietary companies. However, if a grandfathered entity is now small, I think they should consider continuing to have an audit and prepare financial statements in order to maintain that grandfather status, because if that entity maybe become large again in future, if they haven't had an audit and they haven't continued to prepare the financials, they would no longer have that grandfathered status. The next big thing, and it's linked to the Treasury Amendments and the size thresholds to lodge with ASIC, is around general purpose, special purpose financial statements. Now, previously, we have discussed this very messy decision tree on what would be the applicable Australian accounting standards. Now, I'm very honest, when I arrived in Australia 18 years ago, I really struggled to get my head around this concept, special purpose financial statements. Where I come from, we don't have that. And I started putting this diagram together. And I think I'll have to redo this diagram very soon if I look at all these changes that are coming through. So currently you can see on this diagram, the red bit or the pink bit is all around the entities that's allowed to prepare special purpose financials. But also you can see there's a lot of question marks there. There's a lot of red areas there. And a lot of uncertainty. So the AASB is trying to address that uncertainty by extending the application and preparation of general purpose financial statements. And I'll look at that very soon. So currently, you ask the question, is an entity a reporting entity in terms of SAC1? And if you say yes, you do special purpose financial. So you prepare general purpose financial statements, and there's 2 tiers, a tier 1 and a tier 2. And currently, that tier 2 is reduced disclosure requirements. So it's all the recognition and measurement, but you'll have less disclosures, which has been custom developed in Australia. So the future of special purpose financials, going forward, the proposals are that as soon as financial statements are required to be prepared in accordance with Australian accounting standards. For example, you have to lodge with a regulator like ASIC, ACNC, and you have to lodge financials prepared in accordance with Australian accounting standards. That would mean general purpose financial statements. Only general purpose financial statements would be in accordance with Australian accounting standards. So if there is no requirement to comply with Australian accounting standards, then you could continue to prepare special purpose financial statements. I think the key thing here is that you have to ask yourself, why are you preparing financials? Who are you providing it to? Where are you lodging it? What act, regulation, bank, trust deed says you have to prepare financials, and what do they say? What do you have to comply with? If you have to comply with Australian accounting standards, has to be general purpose. So you can see on our previous diagram, that first question at the top in blue is the entity reporting entity as defined in SAC 1 will no longer exist. SAC 1 will be repealed. There will be no reporting entity concept. The question will be, do you have to prepare financials in accordance with Australian accounting standards? Yes or no. If you have to prepare it in accordance with Australian accounting standards, has to be general purpose. If not, you can decide whether you want to do general purpose or special purpose. Some practical implications. If you're currently lodging special purpose financial statements with ASIC or the ACNC, there's two potential issues. Are you complying with all the recognition and measurement requirements of all Australian accounting standards? If you are already complying with all the recognition and measurement, although you're lodging special purpose, you will be in a good position to transition to general purpose, and you'll just have to include additional disclosures. However, if you've not applied the recognition and measurement of certain standards, problematic. And the other question, which I think is more widespread, is, are you currently lodging parent entity financials with ASIC, or are you lodging consolidated financial statements with ASIC? So a lot of entities are lodging parent entity special purpose financial statements with ASIC. In future, if you have to lodge with ASIC and you have to prepare financials in accordance with Australian accounting standards, it will have to be consolidated financial statements. So really important to consider those. Also, if you are currently preparing special purpose, even though you're not lodging with ASIC or the ACNC, why are you preparing financials? What are the requirements of that trust deed, association, bank? Are they requiring compliance with Australian accounting standards? Yes or no? As soon as they require compliance with Australian accounting standards, it will have to be general purpose financial statements. The other thing that's interesting is that the ATO has come out with new rules around significant global entities. So even though you're a small entity, in Australia, because you are part of a significant global entity, you now have to lodge general purpose financial statements with the ATO, and the ATO will provide those to ASIC, which will make it available publicly on its database. So there's also pressure coming not only from the AASB and Treasury and ASIC, but also from the ATO. So there's a real push and there's a trend towards general purpose financial statements. So which entities will be impacted by the requirements around significant global entities? If you're already lodging general purpose financial statements with ASIC, no problem. However, if you currently lodge special purpose financial statements with ASIC, it will have to be upgraded to general purpose, Tier 1 or Tier 2. If you do not lodge currently with ASIC, maybe because you grandfathered or because you're a small foreign controlled entity. So you've applied the old class order 9898, doesn't matter. You will have to upgrade then to general purpose tier 1 or tier 2 financials, lodging with ASIC. Another part of the momentum towards general purpose financial statements is around crowdfunding. We know small proprietary companies can now access crowd-sourced funding, and certain rules on when you can do it. The implications, however, for these small proprietary companies is as soon as a small proprietary company have raised more than $3 million cumulatively, so it's not an annual limit, they have to prepare financial statements in accordance with Australian accounting standards, which would mean in accordance with Australian accounting standards, we're looking at general purpose financial statements. So again, another piece of the puzzle. Another question is, what about some simplified or specified disclosures for Tier 2? So currently, if you're a reporting entity and you're preparing general purpose financial statements, there's a distinction between Tier 1 and Tier 2. Tier 1 is all recognition, measurement, disclosure, everything. And Tier 2, you do all the recognition, all the measurement, but your disclosures are reduced disclosure requirements specifically developed by the AASB. The AASB, however, have put out an ED where they are contemplating to replace reduced disclosure requirements for Tier 2 with simplified disclosures. And the simplified disclosures will no longer be custom developed by the AASB for Tier 2, but it will be based on the disclosures currently contained in the IFRS for SMEs. And please note, we will not be adopting IFRS for SMEs in Australia. The disclosures will just be linked, or they would consider disclosures in the IFRS SMEs to inform them on what should be required in Australia. Going forward, these disclosures for Tier 2, the proposal is to have it in a separate standard to make it easier for Tier 2 to have all the disclosures in one document and no longer having to go to all the standards and to see what is grayed out and what's mandatory. So that's an ED at the moment. And then the next thing that's linked to this is that there's currently a proposal that if an entity is currently preparing special purpose financial statements, that entities consider or disclose very clearly exactly the recognition and measurement requirements that they're complying with. So if you're doing special purpose, be very clear in usually note 1 on which standards you're complying with and which not. The focus obviously just on recognition and measurement. If you comply with the recognition and measurement of all accounting standards, it will make the transition to general purpose financials a lot easier. So it's like a stepping stone. And then the big one to look out for obviously is, are you preparing consolidated financials under AASB 10? And then the last part of the Australian developments at this stage, there's also a ED out to assess whether an entity is a for-profit or a not-for-profit entity. Please note that this is a for-profit or a not-for-profit entity for the purposes of accounting standards. It's not interfering with any other status, charity status, etc. of the organization. So are you a for-profit or not-for-profit entity for accounting purposes solely to determine which accounting standards you should be applying? I also want to highlight some corporate governance principles. The 4th edition has recently been issued for listed entities. Important to be aware, as we know, very important corporate governance, a lot of media around corporate governance. So in the 4th edition, we still have the 8 principles. We have additional recommendations, and to make sure that we comply with these and that we also disclose and prepare our corporate governance statement. So this is for listed entities. The next section is around our ASIC regulatory activities. Now, ASIC regulatory activities, we know ASIC reviews financial statements that's been lodged with ASIC. The latest findings have been released, and that is findings from the review of 31 December 2018 financial reports. ASIC reviewed 125 entities. They looked at 85 full-year financial reports and 40 half-year reports. And as a result of ASIC's review, they made inquiries of 26 entities. So 21% of the entities reviewed, ASIC actually contacted and asked further information and questions. And it was on 40 different matters. So I thought, oops, would be interesting to know which particular matters they raised questions about. ASIC also provided some findings around how many of the questions they've asked actually led to material changes, which is important for users to be able to rely on financial statements. If we look at those queries that ASIC raised, not surprising at all, impairment and other asset values, 32.5% of the queries. Revenue recognition, 30%. Now, those two I can understand because impairment is linked to impairment of financial instruments, the new IFRS 9, but also impairment of other assets and determining fair value. Difficult areas. And then the second one, revenue recognition, we've got a new IFRS 15, and both of those were applicable for 31 December 2018 year ends. There's also other queries around non-IFRS measures, tax accounting, consolidation, business combinations, amortization of intangibles, and a few other matters. So I thought quite interesting statistics to share with you. The focus areas that we expect for 2019 are very similar. We expect then the focus areas for 2018, the impact of new standards, the application of the new standards, IFRS 16, IFRS 23, and then whether the extent of our disclosures are acceptable. And then also a list of other things that ASIC has traditionally focused on. Operating and financial review, non-IFRS information, impact of the new standards, impairment testing, revenue recognition policies, expense deferral, off-balance sheet arrangements, tax accounting, and also disclosure of key estimates and accounting policy judgments. I would like to end our session looking at how BDO can help you. We know what is next for our for-profit entities. It's all about leases, as well as IFRS 23. And for our not-for-profit entities, AASB 15, 10, 58, and 16. So for not-for-profits, definitely 31 December 2019 financial reports, a big thing. We have a lot of free resources at BDO. We've got the monthly webinars. We've been doing those for the last 3 years, and we'll very soon release the schedule for 2020. We've got accounting standards training on our website, especially the e-learning on 9, 15, 16, and also 1058. And I must say I'm very proud of the team that's developed all of that. They've done amazing work. And then IFRS publications, there's IFRS in practice for IFRS 9, 15, 16, those developed by BDO Global. And really a privilege to be part of a global organization. And then particularly for IFRS 16, there's a lot of resources as well. If we look at AASB 16, whether you're for-profit or not-for-profit, I would say broadly speaking, if you've got less than 10 leases, a lot of clients are trying to do it in Excel with various levels of success. We could also do lease management services for those. 10 to 200 leases, absolutely, too much for Excel, but not enough to pay for a software as a service solution. Please outsource to us, happy to help you. And more than 200 leases, I think you should start to look at software as a service. We're also running a number of masterclasses and financial reporting updates in our various offices around the country if you would like to attend face-to-face discussions. Potential problems with Excel, speaking to clients who's tried to do lease accounting in Excel, you know, there's a large volume of Excel spreadsheets per lease. There's a lack of an audit trail, which the auditors find confronting. There's some file corruption issues. It's a static model often. There's issues with version control, issues around budgeting and forecasting, and the big one is the ongoing changes to leases, the ongoing recalculation of the amortization table and depreciation, and it really comes back to this decision tree, which we've discussed earlier today. If you are considering outsourcing, please feel free to contact us. Our lease management services are starting at around $5,000 per year. It can be provided to non-PI audit clients of BDO. This is an overview of our process to get all your data ready for us to manage it for you, and this is an overview of the monthly process on how we would work with you to make those ongoing monthly changes. If you are looking at a software as a service solution, a cloud solution that you'll operate yourself, it cannot be sold or licensed to audit clients of BDO. However, if you're not an audit client of BDO, we can speak to you about that. If you want to register for any master classes, you can do that on our website. And as always, if you need any assistance, please feel free to contact any of our 5 IFRS partners or your BDO contact person. They will get in contact with us. This is our large team these days around IFRS advisory across the country. Lynn, there at the bottom row, is based in Adelaide. We've got a number of people in Sydney, Christine, Alison in Sydney. We've got people in Melbourne, Dean, Anita with me. We've got people in Brisbane, Clark and Julie, and also Wayne and Susan, Sue Healy, Ashley, etc. in Perth. So please feel free to reach out to any of us. If you've got any questions, please feel free to contact me or any of the team. Thank you very much for joining us today for this webinar. We hope you enjoy the rest of November, and we'll speak again fairly early in December for our last webinar for 2019. Take care.